All right. Now, a couple things. Obviously, the we have Chairperson Powell has been speaking, which I'm sure we're all aware of. Two things happened that were, as I mentioned earlier, could be significant. So the bond auction was weaker than expected. Okay, so this is not a good sign. So we had the 30-year bond auction today. Weaker than expected, meaning there are fewer buyers of debt. So there are big banks that are obligated to buy, and they bought about double the percent that they usually would of the available bonds. I think it was like $24 billion that was auctioned or whatever. So short, long story short, this was actually not a good result. So as a result, the market, as you can see here, it began to crash right at 1 o'clock, 101, right? That's exactly when the bond auction came out. So once the data came in and it was clear that the auction was weaker than expected, price came down for the market. Okay, so I mentioned that earlier that can, if it's a surprise and it's not a good result, then the market will respond. That's always the case. If it does everything that was expected, no big deal. All right, now I never actually learned how to read these numbers. I just look up the commentary on it. Biggest tail on record. Interesting. U.S. Treasury auctions off 24. Yes, true. $24 billion of 30-year bonds at a high yield of 4.79%. This is very technical stuff. But anyway, you get the point. All right. There were some news articles about it. I'm just going to skip that for now. But if you look it up, you can see lots of commentary on what happened today. But the bottom line is things didn't go as expected, and the market interprets that negatively, which is why we went down. All right. Now, having said that, um, the other major thing is Powell, who is, I'm assuming he's done speaking at this point. So Fed Chairman Powell speaks. That started at 2 o'clock Eastern. Since there's open Q&A here, so let's see. Fed's Powell, a greater share of progress on inflation ahead may have to come from tight monetary policy. Let's see. Opening remarks, and then we have the Q&A. Greatest share of progress on inflation ahead may have to come from tight monetary policy, not just supply side improvement. Fed's Powell emphasizes being attentive to risk of misinterpretation by data and the danger of over tightening. He notes that inflation has given us a few head fakes. Fed's Powell leaves the stage at the IMF event after arrival of climate protesters. Powell retaking stage. Okay, there you go. All right, so I guess there was a little bit of dramatic stuff there. Let's see, do they have an actual video of this? Okay, that's not the one. Um, all right, so they're still going until 3:30 Eastern. They'll have a coffee break, and then they go into some other stuff this afternoon. Okay, so still going, but Powell's done. All right, so lessons learned from this. Let's just make sure we all remember what the lessons are. The lesson is that if there's major news, major commentary that's of some importance, it does move the market. Okay? So, despite what anyone tells you, the market is always going to be impacted by information, especially information coming from a major source. Now, you can see that on my watch list here in the middle, there's a complete lack of things going up. Meta is actually up 0.23% since the opening of this session, above its opening price, but that's it. I mean, that's the best performer of the day, and everything else is down. So overwhelmingly, the market turned bearish. And that all started at the bond auction. So this is the reason why pre-market as well as before, right at the opening bell, I remind you guys that there's news coming out. You can all go to forexfactory.com/calendar to keep up on what's coming out. Okay, this is a free resource. You don't have to pay for it, but you can't really ignore news intraday. Okay, that's a very bad mistake. If you're day trading, you got to know when major releases are coming out. Otherwise, you get caught on the wrong side of the market most of the time. Now, also, it means that we can't effectively trade the news. I know this is something that a lot of people want to do, but in reality, it's a lot harder to achieve than it seems. And more likely than not, you'll misread what the reaction will be. So oftentimes the reaction is not even clear. The market goes up and down in both directions. So it's not like it just goes one way. In this case, it did. And if most situations were like that, then it would make it a lot easier. But in order for you to anticipate this reaction, you would first have to know what everybody's expecting. And that's not that easy to detect sometimes. This time, I guess it was easier, but usually it's not. So the point is, the larger players that move the market, they never tell you what they're going to do. They don't just call us up and say, hey, when this news comes out, here's exactly what we're going to do. They don't do that because why would they give away their hand? Okay, this is a competition, so they want to keep their cards close to their vest, to use the analogy. They don't want you to know what they're holding. They want you to not know they want everyone else to know as little as possible, including their own colleagues. So once the news comes out and once the results are in, then we see the reaction. So the danger is we don't know what they were expecting. Maybe they were already expecting that this would be the result. Maybe they were expecting that there would be a weak bond auction. But apparently they weren't expecting it to be as weak as it was based on the response. So we only know it after the fact. And as you can see, it went down at first, everything looked good, then it turns right back around. And I'm pretty certain most of us would not be in the trade right here. We'd be looking to get into trade right about there, or maybe right about here, right? And then it suddenly turns the other way. And then after it's going this way, we might say, okay, things are bullish, let me buy, and then it comes down, and then it goes down again. So in short, there's no way to really effectively trade this stuff until it gets into a solid trend. And even when it does, we have Powell about to speak. So that kind of means that even if we did get into a trade after things start to trend, it's hard to say if it will continue after what he has to say. So in short, so far it looks like the market has interpreted the results of the auction and the statements and comments made by Powell in a negative way, and therefore the market's come down. All right. Now, having said that, some mistakes that we might have made that I'm going to go over right now. Okay. So remember that when we look at trades, when we look at trends, it's only as good as what it's doing. So in other words, this is not a situation where I look at a stock. I'm just going to use an example from something that I saw today. I saw someone do this today, so let me point it out. So this is the stock Roku. Okay. I pointed out Roku earlier, did I not? Yep, I said here, this is the target number 1, or was it number 2? It was either 1 or 2. I have to look up. Well, let's see, where is it? Roku was 2. It was T2. Okay, so Roku took off earlier in the session. Here it is. So Roku went on a good, quick move up. Everything looks fine. Everything looks good, right? So I give you T2. Once it got to T1 and it started to advance some more, I gave you T2. Now, the expectation was it was going to go through there, pull back, and then possibly resume. That would be what we're looking for. So let me make sure I'm clear. What we were looking for is it to do this, do that, and then resume. Do this, do that, and then resume. That's what we wanted. Okay? This, that, and then resume. That's what we're looking for. Or possibly it could have done something a little different. It could have done this, kind of like that, and then later resumed. But whatever the case may be, that's what we're looking for. That's the pattern we're looking for. We're looking for a pattern. Okay? We're looking for a pattern. So, let's talk about patterns. If I say to someone, I'm looking for this to happen. Okay? That's what I asked for. But instead of getting this, let's say I get something that goes like this. And then that's it. And then it does this. Not the same pattern. These two things are not the same. So if I'm looking for a pattern, and it says the pattern's supposed to go this, 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 but instead it goes this, this, then that, not the same pattern, right? So if I'm looking for a pattern, it means what it says. So if the pattern says it's supposed to do this, but instead I get this, not the same. They started off the same, but this one, different. That's a number 4. That's the pattern for a number 4. This is a pattern for a number 1. Now, I'm not talking about chart patterns. I'm saying everything that you look at, this is a pattern. It's the letter A. That is a pattern. That's the letter V. This is a pattern. That's the letter G. This is an O, or it's a 0. But if it doesn't match exactly what I'm looking for, then I don't have the pattern. So what someone is basically doing, if they don't think of it this way, is like this. Someone says, hey, let me know if the number 4, let's say there's an auction or something. Let me know if the number 4 is called out. Let's say your order number is 4. Someone says, yeah, they called out this. I'm recording. And I say, well, no, that's not the pattern I'm looking for. I'm looking for 4. And they say, no, I mean, same thing. And I say, well, this is also a 4. That's also a 4. And I say, yeah, what's the difference? So, well, no, this is a 9. That's a 4. There are different ways of writing it, but both of these are not the exact same pattern, but they're understood to be equivalents, right? If we understand the concept of a font, which is a style of writing, then we will recognize that, okay, 4 could be written like that. It could be written like this. Someone might do this. Someone may do like, right? Someone may do like this. Someone may do like that. They're not exactly the same, but in the context, we would say, hey, that looks like a 4. So obviously, the more it looks like 1, the more likely we conclude it's a 4. Or 4 could be this. Roman numerals. That's a 4 as well. But we would have to know what that means, right? So if I'm looking for a pattern, I'm looking for something specific. So if I'm looking for specifically this to do this, 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 or this to do this, and maybe something comparable, that's what I'm looking for. So if it does this, what it did now on the screen, if it goes like this, that's not what I was looking for, because I was looking for it to stabilize up here where I had T1 that it just passed. So if T1 is going to mean anything, At least at that time, I want this to stick around. Then maybe it comes back later and gets into a nice trend afterwards where I have to sit and wait and see if it looks like it's still going. But my point is, there was an expectation. The expectation was here's T1, and I'm expecting it to go up to wherever it is, T2, which was at 87.52. That was T2. Well, this never got to 87.52, never even got close. It topped out here at 86.40. That's where it topped out. Okay, that's supposed to be a 4, and that's supposed to be a 6. Okay, all right, that's where it topped out, 86.40. Right? Okay. If someone hands you something in writing and you can't read it, you say, you know what? I'm not sure what this says. I'm looking at it, but I'm not sure what it's saying. Is that a 4? Is that an I? Is that a T? Right? Sometimes people have handwriting that you can't read. So you have to ask, right? But if someone says, are you certain that this is what it says? If you're not certain, you'll say, you know what? I'm not really sure. It kind of looks like it might be saying this, but it's really, really really weird. If something looks really clear, if it says stop, and you say, what does it say on the message? Oh, it says stop. Or maybe it looks kind of like, so it's not perfect, but you say, yeah, it looks like they said stop, right? That's what it looks like it says. Okay, that's it, right? Most people would see it and say, yeah, it looks like stop. Okay, so we're looking for a pattern. So if I see it does this, instead of doing what I thought was going to happen, which is this, it does the opposite, it goes down, then that means at this point, this is a no. But let's say I get in anyway. I get in anyway. Sorry. And let's say I get in right here. That's your entry. Okay, E for entry. So I'll get in right here. And at first it's going against me, so I'm losing. And then it starts to turn around and go up. Now I know there was a T1 up here, somewhere around there. You know, there's T1. And I know it's up there because it's published inside of the announcements. And as it's going up, I'm starting to make a little money, start to make some money, and then I get to here and things start to shake up, and then they start going the other way. Now, if I'm looking at this closely, I can notice that a lot of things changed. The VWAP, the standard VWAP, was going up at first, but then as of right here, it starts to go down. Now the standard VWAP, the VWAP, this is the standard VWAP. This is the you can call it the main VWAP, the official VWAP, whatever you want to call it. But this is the VWAP, the line that's I'm sorry, that not sorry, that's the not the main VWAP. Sorry, that's the intraday VWAP. I meant to say. Excuse me. The intraday VWAP. This is the 21 period. It's not technically the VWAP. It's the 21 period weighted moving average, weighted by volume. So it's a volume weighted moving average. Volume weighted moving average. Okay. Which is basically a moving average is an average price. Yeah. Middle of the Bollinger Bands. You got it. It starts to go down. Also on the standard VWAP, that flattened out here. Then we start to go below that as well. So there's not much over here on the right hand side. There's not much over here that suggests bullishness. Everything looks like it's bearish. Okay? At the best case, your absolute best case, it's mildly bearish. But what do we want? If we bought, we want it to be bullish. We want it to go up. or at least hold its ground. But instead it's sinking, sinking, and sinking. So if I keep holding this and holding it and holding it and holding it and holding it and holding it, there's no way that this is going to end up being the setup that I was looking for, because once it broke the pattern, it can't be that anymore. So it has to do something else after this to potentially put it back into contention. Once the pattern is broken, it's broken. So it then has to do some other pattern of trading that at least suggests that maybe we're back onto bullishness. Bullishness could look like this. It can look like that. It can look like this. It can look like that. Bullishness just means things are tending to go up, but it doesn't say how. Bullish just means things tend to go up. Strongly bullish means things tend to go quickly and strongly and consistently up. So this, strongly bullish. This, strongly bullish. That, strongly bullish. Even this, strongly bullish. Strongly bullish means that things are tending to go quickly, concisely, and very predictably in one direction. So this clearly, at that time, was strongly bullish, which means that this must be strongly what? When it reversed like that, is that strongly bullish or is it something else? What would you say? Exactly, strongly bearish. And it doesn't mean it's going to keep going down, doesn't mean that, but it does mean that whatever got people buying here, they suddenly and very abruptly changed their minds and gave up nearly all of the gains that were made. So nearly 100% of the profits made here were, if they were buyers, were given up in almost the same amount of time. That does not look right. That looks like something has sharply changed, and I don't want to buy that. Maybe if things calm down later and get back into a more stable trend, perhaps, but this looks like a rocket that literally ran out of fuel and its turnaround is about to crash, or a plane that took off and suddenly starts to nosedive towards the ground. That's not what's supposed to happen. If you get on a passenger jet and everything's going like this, and then all of a sudden the plane starts to go like that, are you going to be sitting there saying, oh, everything's fine? No, the first thing you're thinking is, oh my God, what just happened? Are we going to crash? It looks like we're going to crash. I'd be thinking that. If I get on a plane and suddenly it drops out of the sky, yeah, I'm thinking we're in trouble. I'm not going to be thinking, oh, that's normal. That's not the pattern we're looking for. The pattern we're looking for is the plane takes off and kind of gradually goes up and then it coasts for a bit, then it goes up and it coasts. That's what should happen. That's not what's supposed to happen. That means you're going to be dead. Right? Not what's supposed to happen. Right? If we're supposed to be flying to a certain destination, but if the plane's supposed to be going north to a destination, but instead it turns around and goes the wrong way, that's not what's supposed to happen. Wrong pattern. Wrong direction. All we have to do is ask ourselves, is this following in line with what's supposed to happen? Yes or no? The less it looks like it's doing what we want, the less likely it is going to do what we want. The more it looks like it's doing what we want, the more likely it will continue to do what we want. The market is not that hard to understand at that level. If the bulls keep buying, the stock will tend to go up. If the bears keep selling, the stock will tend to go down. No, actually, I think I know what you're talking about. I thought that was the Boeing or something. So, my point, guys, is simple, right? My point, guys, is very simple. Look for the pattern that we're supposed to be finding. If it doesn't look close to what we're looking for, then That's not what we're looking for. So the person who bought in this situation, they were looking for a price to come back up. And it did at first. And they had a chance to get out a long time ago, but they held and they held and they held. So what ended up happening is for that particular trader, I'll just walk you through the actual sequence of events so you can know what happened. Okay, so this is exactly what they did. Trade for trade. At 9:50 a.m., they bought. Now 9:50 a.m. is about right around, that's 9:49. That's right about here. So they bought here, right, somewhere around there. They bought. Things then went down at first, but then it did turn around. And I want you to notice they had more positive movement after the entry than negative movement. They did jump the gun. They got in too early, but still, it worked out. They were able to see more positive than negative. So this trade was going fairly well. In fact, they were up probably, my best guess is they were probably up twice as much as they were down at some point in this rally. So that trade at first was working out. Then the market turned around. Okay? So at 10:18, which is right here, that's where they sold. So they bought here and they sold here. Now by that time, the market had been going down against their position for at least 3 times the time that it was going in their favor. And on top of that, the distance was 2 times against as it went in their favor. So I want to leave that on the screen for a second. I want you guys to think about this. What would convince a person after they saw a gain that was twice as much as they were just down to stay in the trade and let it keep going and keep going and keep going and keep going? In fact, this exit here was forced. What do I mean? The system kicked in to force them out of the trade. So in other words, they weren't planning to get out. It actually, the system got them to where they had to get out. Maybe not. Maybe they weren't. But that's the bigger question. Regardless of the reason, was there any good reason? I mean, if this is my account and I'm trading money, why would I even put myself in a position where that might happen? If I have to walk away, then I need to exit my trade. Unless I have something, unless I put something in place to stop me out, if I can. If I can't use stop losses because I'm using options and our platform doesn't allow that right now, okay, well then I need to set up an alert to let me know when I'm losing, when the position's going the wrong way. If I can't do any of those things, then get out. But why would I leave the trade open and knowing that I can't actually monitor it? I can't do anything about it. So no matter what the reason is, the only reason I can give that would actually be justifiable is if the person literally blacked out and came to and they realized they were losing and they got out of the trade. Okay, that's an acceptable excuse because there's nothing you can do about that. But if the person says, yeah, my internet went down, pick up your phone, call the desk and say, hey, I've got a trade on, I need you to exit. That's what I've always done. I don't ever remember a time where I lost the internet or I lost something on my computer and I said, you know what? I'll wait for it to come back on and see where I'm at. No. Why would you be crazy enough to do that? That's actually crazy to do. That's insane to do. Why would you leave it on when you can't do anything? The first thing is to call and say, hey, I've got a position on. I need you to exit me out of this trade. My internet went down. That's it. That's what the desk number is for. in case something like that happens. So if I don't do that, if I just leave it on, there is no excuse. This is poor management, period. No matter how you cut it. The only excuse, literally, is that something happened to physically prevent the person from being able to do anything. Literally, they're knocked out or incapacitated somehow. Okay. Phone was lost, internet was down. Okay. But I doubt that's what happened, because as soon as the system kicked in, the person started to make some attempts to exit the trade. So they were watching it, because as soon as it hit the max, they took action. So they were watching it, unless it just so happens that right at that moment was when everything came back. So my point is, look, there's always a possibility that something bizarre happened, but there's no excuse for me saying, "Oh, sorry, I forgot about it." Sure. Before I jump into that, guys, I really want to make sure you get this point. We're looking for a pattern. If the pattern does not follow through, that doesn't mean that we stay with it. We're only interested if things are going according to plan. So if the plan's not working out, if things are not playing the way they should, then that's it. Right? All right. Now, regardless of what happened, as long as when I say call, you can message them too. Like, in other words, I would always have on my phone like the email address or whatever, because that's usually faster. So always have that information prepped on your phone. Like, actually have it ready. In other words, if you're trading, one of the things that you should be expecting is that things will go wrong eventually. You should be prepared for that. I should be prepared. I should have a plan of action if my computer goes down, if my internet drops out, if my mouse stops working. I should have an actual plan. Obviously, there are going to be some circumstances you can't do anything, but if you have no plan at all to deal with a situation like that, then what are you doing? In other words, what if our brokerage firm said, "Oh yeah, we had a system outage, but we don't actually plan for that. We don't have any preparation for that at all." You say, "Well, what are you talking about? System outages are bound to happen. You don't have a plan?" "Oh no, we don't. If it happens, it happens. Whatever." How many of you would still do business with your brokerage if they told you that over the phone? That they don't even plan for events like that? Anybody still want to do business with that broker? Seriously, serious question. So then the big question would be, why would anyone want to do business with a trader who does the same thing? That's the bigger question. Why would we want to tolerate traders who do the same thing? Why would we want to give them a pass if they don't actually take it seriously enough to have a plan? Because it's up to you. We can't do it for you. Let's look at CrowdStrike. And of course, the answer is we won't. If you're not taking it seriously, then we cut you off, whether you're funded or not. So that's a very clear warning. If you're funded and you do stuff like that, we have every right to cut you off. Look at CrowdStrike at 1016. Okay, 1016 went down. I guess it went down and then went up. Okay, got out 1055. I'm not sure. 1016 Eastern, I'm assuming? Or are you talking about 916? Well, I guess it has to be 1016. Yeah, okay, never mind. I guess answer my. Well, no, it could be 916 some other time. 55. No, there's not, David. Now, crowd strikes start the day off negative, that's for sure, but as soon as it goes the wrong way like that, that's not what you're looking for. So I'm not sure if this is where you got in or if you're talking about over here, but whatever the case may be, this was going down, but once it starts to go up sharply, that's it. I mean, if you're bearish and it starts to flip the other way, then you shouldn't be in it. Okay. Yes, this is recording. So if you got in, let's say you bought here, I wouldn't have bought anyway, but if you did, remember, guys, look, if remember, I keep emphasizing that you don't have to pick stocks that do this. Like, I mean, I can understand at the open, it did look like it wanted to go down at the open, but then it really comes back up. Then so after this big pullback, I'm not looking at this at all. You want to look for things that are more smooth in their action. You don't want things that are really swinging in wide ranges. I mean, look at the bands. They're really wide, which means that there's a lot of volatility here, so it's not likely to work out. Compare it to over here, that's what you want this to look like. It's more compacted, it's smoother, much easier to manage. This is manageable. This is like the bucking bull over here. So if you try to get into stuff like this, you're almost certainly going to get hurt. But if you get into something that looks more like that, even if this wasn't it, that's more likely to win. But the pattern, if I were bullish here, which I wouldn't recommend, but if you did, you pull back and it's supposed to start to go up, but it really doesn't. It pulls back, goes flat, and then sells off. That's not the pattern you want. So I'm not sure this is what you're referring to, but if for some reason I decide to trade this and I say, okay, it's up, I'm expecting it to do this and do that, but instead, what it does is it does this and then sells off. The pattern I'm looking for was this. The pattern I got was that. This is not the pattern I want. That's the pattern I want. So as soon as it does that, trade is over. So we're not trying to say, I'm looking for this, but it goes this, but I'm saying, okay, well, what's going to happen next is it's going to do that. Well, was that the pattern you were looking for? In other words, if this is what I'm looking for, but I get this instead, then I start saying to myself, okay, well, I see that happening, but here's what I think is going to happen next. I think next it's going to do this. Well, maybe it does, but you were looking for that, not that. So if it's not playing out the way it's supposed to, whereas if this was one of these scenarios I'd already bargained for, so I positioned myself properly for both scenarios, then it could work out. But if I'm purely positioned for this to benefit me, but not that, then this is fine, but that would not be. If I'm properly positioned for both, then maybe I can work out both scenarios. But there's no trading strategy that's going to work in every outcome. Any strategy you choose, it has to have the right set of circumstances that happen to make it work. So again, it'd be like if you do sports betting, right? If I bet on a game, sports betting always has these different, like, I don't know sports betting well at all. I don't do it. But at the same time, I know that you have all these different rules, like they have to win by this amount and by this time, and who's going to be up, who's going to be down, minimum score. They have all these different rules. Why? Because the more rules they give you, the more conditions that are needed, the harder it is for you to win. The bookie is looking to win, so they give you as many different obstacles as they possibly can to make you lose. Okay, that's simple enough. But what that means is the only way you win the bet is if the pattern that they say has to occur. So if it says One team must win, and they must win by a spread of X, and there must be a minimum score of Y. If that doesn't happen, you lose. Simple as that. If the only conditions are one team, I'm betting that one team's going to win, the other team's going to lose, and there's no other conditions but win, lose, that's different. Then there's no minimum spread, there's no minimum score, there's none of that. It's just one wins, one loses. That's a simple bet. But in trading, we can't bet that way, because if I just say, I'm going to buy right now and I'm betting that the price is going to be above where I got in a bet that you do with a bookie, you don't make more money if you're betting that one team's going to win or lose. You don't make more money because the team wins by a larger score. You just make the same amount of money when you win, and you're going to lose the same amount of money when you lose. No matter how the loss occurs, if you bet $1,000, then if you lose 1,000. And if you're supposed to win 3,000, if you're right, then you're going to win 3,000. So if the team wins by 10 points, you get 3,000. They win by 20 points, you get 3,000. They win by 70 points, you get 3,000. No matter what happens, you're going to get the same amount of money. And if they lose by 1 point, you lose 1,000. Lose by 2 points, lose 1,000. Lose by 100 points, whatever, you lose 1,000. That's called a binary outcome. That's why they had that thing called binary options. That's why people liked binary options, because with binary options, you either win or you don't. But you don't have to worry about by how much. So binary options is purely simple odds. Simple odds. Is it going to happen or no? What's the probability? When you look at options, they have the probability that an option strike price will be touched, or that probability the option will expire out of the money. Those are simple equations. If the option is 1 penny out of the money or $5 out of the money, it doesn't matter. It's still out of the money. If it's 1 penny in the money or $100 in the money, it doesn't matter. It's in the money. So if you could actually make trades based on that alone, then the pricing of the bet would be based on what the calculated odds are. But when you're trading in the actual market, whether you're doing options or stocks, the degree to which things go in your favor actually matters. So if I buy here and the market closes higher and I make money, that's fine. But the degree to which the market goes against me could actually kick me out of my trade, because maybe I don't have enough margin, if I'm trading my own account, to stay in the trade. Or maybe I have a risk limitation on my prop account that will stop me out for the day. But if I didn't have any restrictions other than if I run out of money, I'm done, then here's what would happen. I would basically not know what to expect out of my trades, because I'm not making a decision based on the degree to which something goes against me or in my favor. I'm just saying, I just think it's going to be closing higher than where it is now. That's it. And if it closes higher, then I just take my profit and I do it again the next day. That's not an effective way of trading, because there's no controlling of the risk. Imagine going to your broker, Thinkorswim, E-Trade, Schwab, whoever, and saying, hey, I know that I have a limited amount of money in my account, but if I buy into a position, I'm using margin, and I lose the equity in my account, I need you to leave the position on, because it could come back. And it's not fair of you to exit me out of my trade before I have a chance to make a profit. Because see, this other example here, I know I got into this trade a long time ago and my account blew out and you guys liquidated my account because I couldn't meet my margin call. But look, that stock eventually came back. So if you left me in the trade, everything would have been fine. The brokerage firm would look at you and say, are you nuts? Who would even make that argument? Only a fool would make that argument. Only someone who doesn't understand reality. The reality is, yeah, sometimes it comes back and a lot of times it won't. So is the broker going to say, hey, let's just assume all that risk? No, the money has to come out of your account. And if you lose it, then they're not going to let you they're not going to let you do any more trading until you've put up the money. Any more than a bookie is going to let you keep, well, they're not supposed to, but any more than a bookie is going to let you keep betting when you're losing and that you owe them money. I mean, they might let you, but eventually they're going to say, hey, all right, enough's enough. They might do it because they say, oh, you're a good client, whatever, but it would be stupid of them to do that. Very stupid of them to do that because it's all gambling. It's all, I mean, what are they expecting, right? They better be collecting that money, not letting you get away with it if they're smart, right? So we got to be smart about this, right? If I'm looking at a stock and it doesn't look right, don't trade it. Just don't trade it. Now that I'm looking at it in hindsight, it's like, damn, no more looking at TTM squeezed on choppy stocks. Plus, it's not a great smooth trend. Correct. Guys, I know there's all sorts of stuff that you guys are using, and that's fine and good, but here's what I'm trying to point out. There's easier ways to do this, and there are harder ways to do this. We can make this difficult if we want, or we can make it a lot easier. If I find a stock that's trading like this, that's far easier to use. It doesn't matter what I use. In other words, if I'm ignoring this stock because I'm waiting for my RSI or my MACD or my whatever newfangled indicator or old fangled indicator, if I'm waiting for that to tell me what's blatantly obvious, if I'm in an airplane, it's going down, I see it's going down, and someone says the altimeter is not working, do I need the altimeter to tell me the plane is crashing? Can I not see that already? Can I not feel that I'm falling fast? That the angle is pointed in the wrong direction? Do I need an instrument to tell me if the plane is going up or down? If it's going up or down quickly? No, I do not. I do not need that to tell me the obvious. So what we want to do is look for the obvious. We want to look for the obvious situation, not the something that's, I wonder what's going on. Just like I mentioned with handwriting, if it's clearly legible, great. If it's hard to read, not great. The harder your handwriting is to read, the more likely people are not sure what you're writing down. If you're not around to correct it, they're going to try to guess. If it's not something they want to guess at, then they won't guess. If I take my watch down to the Rolex dealer and I say, hey, I need you to fix this and call me when it's done, and they say, what's your number? I write it down. If they can't read it, what do you think they're going to do? They're going to say, I'm sorry, sir. Is this, am I reading this right? Is this blah, 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 blah? Yeah, that's right. If they don't ask, then something's wrong with that person. It's like, why would you not ask that question? Right? If you take your car to get fixed, right? And they write down like, okay, so you said that it needs this, this is wrong, whatever, but they're not sure what you're saying. You're trying to explain what's wrong, and they're not clear. They're not going to just start working on it. They're going to say, well, wait a minute. So are you saying this is wrong? And if they can't figure it out, they say, okay, well, what we're going to do is we're going to do a quick overview of the car. We're just going to look in to see, around that area if anything looks bad. And then basically what they're saying is, we know you don't know what you're talking about, but we're going to look at it anyway, right? But they understand that there's a problem because you came in, there must be something wrong. If you go to the doctor, you can't really elaborate what's wrong, but you can say, hey, my leg, I can't explain it, doc, but something's wrong with my leg. Where are you feeling it? Somewhere around my knee? Is it like in the front or back? They know that you can't elaborate on it. You're not going to tell them what tendon is wrong or what muscle is cramped. You may not know these terms. Probably you don't. But as long as you can generally point them in the right direction, then they can probably figure it out, right? Hold on for 1 second. One second, guys. One second, guys. All right, so in short, look for clearer situations. Whatever you're using is fine, but trying to interpret very difficult to read things is not really where you're going to make your money. Okay? If I can find a trend that's really good, I'm going to make more money on that anyway because it's really going and going and going and going and going. That's where you're going to make the money. You can make a profit off of smaller incremental moves, sure, but they're always going to be much more difficult to do. They're going to be much more difficult to win, much more difficult to master. So why chase them when you don't need to? So since we're looking for stocks every day that are moving, one of the things that I'm generally surprised at when I look at the trading performance for a lot of us is that, I mean, we're finding things that are really moving, but it's like people are ignoring those things and doing other stuff, which doesn't make a lot of sense, right? I mean, if I got something that shot up like Riot today, then it also went down. But if I got something that was going up pretty well in the morning, why would I not want to trade that? Like, what would be the reason to ignore that, but look at something else that's not looking quite as good? Well, let me ask you a quick question, right? I'm reading the question, but I'm wondering something right now. How would you know that you're at the end of a trend until it's already ending? You can know that the trend looks like it's slowing down. You can see that the trend's starting to change direction, but you're not going to know you're at the end until after it's been reached. So I can anticipate that. I can say, well, maybe the trend stops here because there's major support or resistance, but that doesn't guarantee it's going to. The only way to know if you're at the beginning of a trend is that it just started. But again, we're still kind of missing the general point. I give out targets that say exactly where I believe the stock could get to. Those targets basically give me an idea how much room there is left to gain potentially, but that's all I've got. So if I'm getting into Riot and I expect that Riot could get to 1208 or wherever it was up here, which was the actual T2 target. So if I'm getting into Riot and I have a projection that it could get up to here, which it did, and I'm right here after it went up, went down, and starts to go up again, then that's all I need to know. That I can get in here and I have a potential for it to go there. And if I got in here, I still have the potential for it to go to there. That's the expectation of where it could go that I'm giving to you guys. So once I give you those targets, this was T2, that's saying that if I get in right here, that's about as far as I might be able to get. If I get in right here, that's still about as far as I might be able to get. This one, more potential gain for the risk. This one, less potential gain for the risk. But either way, both of those are valid. So we had a move, pullback, and resumption. Move, pullback, and resumption. That's exactly, precisely the precise pattern that we wanted, and we got it. And it happened where there was enough room, to actually make a profit. Okay? So, it's more important to ask, Am I getting a scenario where I can get into a trade when it's doing what it's supposed to do and there's potential room to make some profit? Yes is the answer, then that's a good trade. No is the answer, then it's not. If you stayed in the trades that I mentioned, but you held, if in other words, if the stocks are doing well, then the news comes out and they change direction, that's a given. The news can always change direction. So it doesn't matter what was going on beforehand. Once the news is released, that changes the picture. So the targets, again, these are not guarantees. This is saying if things continue to go in the direction that they're going, if they continue to go in the direction that they're going at the speed that they're going, then I've got an opportunity. If they're not doing that for any reason, then I don't. So this is not about getting married to a expectation. We don't have any way of controlling what the market does, so we're not getting married. We're staying with it as long as it's doing what we want. Once it's not doing what we want, we get out. And what do we want it to do? Keep going in the direction that we traded. If I buy, I want the stock to keep going up. If I short sell, I want it to keep going down. If it's not continuing to do that at any reasonable level, I get out and take the loss, take the profit, or whatever it is. I get out. It's not about me negotiating with the chart to say, hey, I really, really would like for you to do what I want. The chart doesn't listen, it doesn't care. It has no connection to my desire, what it ends up doing, so why would I try to negotiate with it? When I know it can't listen to me, it can't do what I say, it doesn't care about me, the universe is not aligning itself so that Mike Patton wins a trade. The universe doesn't care. So therefore, I'm not going to pretend that I'm important enough that the universe is going to change the way the trade is going to make it work for me. That's not the way this works. All I have to do is observe what it's doing. If I know a major news announcement's coming out that might change the trend, then I need to make sure that I'm not holding a position without being aware of that situation. In other words, if I'm going into that news, if I know Jerome Powell's about to speak, I'm out. I'm not even going to hold. If I know the bond auction is coming and it might actually change the trend, then I'm going to be waiting and waiting and watching. And as soon as it looks like the news is greatly affecting the market, then I get out. I don't try to figure out, well, I wonder which way they're going to go. I don't care. All I need to know is if it gets to that point and the market was doing something and then all of a sudden then no, I'm not staying in. As soon as you get in, the bar goes against you, yeah, that's what's going to happen normally. Most of the time you get into a trade, it's not going to immediately go your way. So if you were expecting that it was going to do the opposite, you are wrong about that. The majority of the time you get into a trade is going to go against you first. Write that down. The vast majority of the time you get into a trade is going to go against you first. That's the norm. The question is it going too far against you? If it's going too far, you should know, because if I'm getting in here, that's where my stop loss would be. Stop, entry. Goes down to stop, I get stopped out because that's going too far against me. Not, well, it always goes against me. I don't know what's going on. I wish this would go my way. It doesn't matter. Just get out. You have to accept results. You can't just fight it and try to make things work. It doesn't work that way. It just either does what it's supposed to or it doesn't. So it's not about every time I get in, it goes against me. That's you telling yourself something that probably is only true at the worst case because you're not getting in when you're supposed to. And if you get in when you're supposed to, it's still going to go against you right away, most of the time. In other words, where I buy, the next thing that happens most of the time is not I buy and immediately the stock goes from where I bought. No, most of the time you buy and the stock goes around And then eventually, maybe if you're right, starts to go your way. That's the norm. The norm is not, I bought here and it immediately goes up to my target and I get out. That is not the norm. That's the best case scenario. But guys, just to be clear, there's never been a point in time that I've even suggested that what's supposed to happen is you buy and immediately things go your way, or you sell and immediately things go your way. I've never suggested that. Never even remotely implied that. So if you're thinking that, it's all in your head. You're literally reading into what I'm saying, what's in your mind, that it's supposed to go perfectly. I've said over and over again, this is about odds, probability, chance, not trying to capture 100% of a move. You're capturing a part of the move. All the language suggests no perfection. No, everything goes my way. No, I win every time. Nothing I've said in the entire history of this program even remotely suggested that. I've said 40% on average of the stocks that I point out are going to work out. 60% on average are not. I've pointed out that your batting percent is going to average between 40 to maybe 55%. Does that sound like perfection? Does that sound like you're winning every trade? You guys have to listen, which is what I notice a lot of you are not doing. You're asking questions that have nothing to do with the conversation. You're literally saying, well, how, I need to know the future. No, you don't. You have to get out of a trade when it's not working out. If we say it's supposed to do this, that's what it's supposed to do. If it doesn't do that, you get out. The reason why most of you are struggling with this, if you are struggling, is because you're trying to do things that are impossible, but no matter how many times I tell you, you're not believing it. You're still going back to, well, this is what I want. Joseph, there's videos on our YouTube channel that explain how to use the platform. And if you're saying that you know how to place a trade, but it's not actually executing, then you want to contact the help desk. So if you know how to place a trade, but it's not executing, contact the help desk. If you're not sure how to place a trade, there are videos on the Funder YouTube channel that explain how to use the software. And you want to go to here. That's our YouTube channel. Just copy that full text and that will take you to our YouTube channel. And there's a set of videos that specifically, they'll be under the playlist. I should probably link you to the playlist, but that's where it'll be. The Bollinger Bands are 21 periods, one standard deviation. You're using the weighted moving average. AMAT was going up, slowed down, fell apart. That's all that happened. Was going up, got stuck, tried to go up some more, not very smooth, but tried to go up some more. It did not, fell apart. So as of, at the very worst case, as of right here, this is where you know this is not looking bullish. Now it's bullish for the entire day, but there's clearly no evidence that this is going to keep going up, or at least nothing that looks like it will. So Elizabeth, let me ask you this. The T1 was 147.01. I'm not, maybe it was, but let's, again, are you clear about what T1 means? It's the expectation of where something might go to. Does it have to go there? Is it required to go there? Like, in other words, do I have some direct line to the stock? No. I'm not saying that's what you're saying, but just making sure we're clear. T1 was about right there. It got to T1. Now we're looking for it to go to T2. It stopped at T1. It never got close to T2. Just fell apart. All right, perfect. So now that it didn't go forwards, now it starts to break down. We're going to assume that it's not going to go up. We're not going to try to do anything else because we can't know. So if it doesn't look right, then it doesn't look right. We get out. Good job. Okay, so if you got out there or got out somewhere beforehand, technically you got pretty close to T1 here. I would most likely have exited here. But again, okay. So now we're not clear. So you say you didn't see it hit T1. T1 doesn't mean you have to exit. So that's not the point. The point is, it doesn't matter if it hit T1 or not. If it starts to go the wrong way, it's going the wrong way. That's where you exit. You don't stay in because it still hasn't hit T1. You get out. T1 is not guaranteed to be hit. It's not required to be hit. That's the point I'm trying to emphasize. It doesn't matter what target I give you. The target is an expectation of how far it could go. But if it goes and then it says, never mind, then it's never mind. That's it. If I'm driving a car and it says on my display, the car is going to be able to go for another 30 miles, and I get to 26 miles and I run out of gas, I ran out of gas. It doesn't matter what the display said. The only thing that matters is I thought I can get to this distance, but I didn't. So as soon as it looks like the car is starting to stutter and everything, then I will realize, oh crap, I must be running out of gas. Would you actually, in other words, let's just use a simple example in regular life. If you're on the highway, your car's display says you've got 26 miles worth of fuel left. That's an estimate. We all know it's an estimate. There's no way that that estimate could perfectly be right. It can't. It's a best guess based on all the factors that it can measure at the moment, which it can't measure if you're going to go up a hill, you're going to burn more gas. You can't measure that. Or if you go down a hill, you'll burn less. You can't measure that until you actually get there. They've gotten more sophisticated, but still, it's a best guess. So if you had two gas stations, one is 10 miles away and the other is 25 miles away, how many of you would actually say, I'll wait to the 25 miles? How many of you would really do that? If you're driving on the highway and it says you got 26 miles left, how many of you would get the gas at 10 miles? And how many of you would say, no, I'm going to wait to 25? None of you would, because you know better. What I'm saying is use the same common sense. If I'm expecting something to happen and it's not happening, you have to accept it. You have to accept that, yes, I thought it could get to here. It's not looking like now that it will. Okay, exit. Okay, Bo, watch the video again and make sure you take a lot of notes on this. And try not, I'm not sure other stuff you're looking at, but it seems like you got a lot of things that you're looking at other than what I'm saying in general. And what I'm trying to make sure you do is just focus your attention on what I'm telling you to do. So you should already know by now what to do with these targets. We've already discussed it before. The targets are not where you get into the trade. The targets are where we're expecting the trade to go to. It's where it's supposed to go to. It's a destination. It's not the starting point. It's the end point of a move. And then maybe we go farther than that. If there's more momentum, then we look for T2. It's a target, meaning it's where something's supposed to go to. That's why it's called T1. So if I have a target that's above me, I'm not getting in when it gets there. I'm supposed to get in before it gets there if there's an opportunity to get in. So if I have T1 up here and the market's doing this, and I say, okay, I'm going to buy here, and I hope it gets to T1 up there, that's the idea. Correct. That's always the way it is. So if we're right at T1, doesn't make sense to get in when we're right there, unless it looks like we can get to T2. Then T2 is put out there, and we now have our next target to go from here to potentially there. But remember, the car might run out of gas before it reaches the destination. T2 is like the display saying, this is how much your car might be able to travel, your trade might be able to travel from where it is now to there. It's not guaranteed. If we get stuck in traffic, if the gas tank leaks, if we hit the gas pedal too hard, if there's too much weight on the car, if the tires go flat, then you might not make it. So better to exit if it looks like you don't have what it takes to get there. If you got plenty of fuel left and everything's going fine, then maybe you can wait for the next stop. Okay, I'll have to go over the entry points again another time, but there's all sorts of stuff, guys, in the folder at the bottom right that goes over things like this. Okay, entries, things like that. There's a lot of stuff there. So I'll go over that again. I mean, we have to repeat this on a regular basis. There's no problem asking that question, just to be clear. But as far as it goes, let's see, what session is that? I'm trying to find which one would have the best. All right, that should be helpful. All right, next lesson we'll go over it again, which is fine. We always have to repeat this, it's no problem. But the basic concept for everybody who wants to know what's the basic concept of trading a trend, the basic concept is always move, pullback, resumption, or move, pause, resumption. Your entry always comes after the trend resumes its movement. Trend is established, pullback, resumption. That's your entry. Now, if you're looking for, well, exactly, precisely, you'll never have that much precision because the market's not going to trade that precisely. It's always going to be general. So sometimes it's clearer. If it's not very clear, if you're not sure, then just don't trade. You never have to trade anything if it's not looking right. So Riot today was very clear. Riot today had a very clear move, at least at the open, where it went as follows. Trend, pullback, resumption. Trend, pullback, resumption. Trend, pullback, resumption. Pullback, no resumption. Sells off. Game over. End. Okay? Now, in this case, it hit T2, so it was most likely going to be over anyway. So in this case, it got to T2. Chances are the stock's going to have problems getting past that point anyway. Sometimes they do, most of the time they don't. So trend, pullback, resumption. 1, 2, 3. It goes, it pulls back and resumes. Sometimes it goes sideways, and then it resumes. This is called pause. This would be pullback. But in both cases, all that's happening is a stock is in motion, it takes a temporary break or it temporarily pulls back and then it resumes. Okay? Markets tend to move in waves. The waves typically, if they're going anywhere, you go up more than you go down, you go up more than you go down, you go up more than you go down. So the trend periods should be farther than the pullback periods if there's a really good trend. If they look about the same, then you're actually neutral, meaning that you're not going anywhere. So unless you see obvious advancement of the price, that's an uptrend. If I see a downtrend, trend period, trend period, trend period, pullback period, pullback period. Okay? That's all you're looking for. It's never going to look perfect, but the more perfect it looks, the more likely you make money. The less perfect it looks, the less you want to trade. So if something is all over the place like this, the QQQ, if it looks like this, that is not what you want. Yes, it's going down, but it's very erratic. It's like going down like that. I don't want to be in that. I want to be in something that actually is giving me a realistic chance of making money. So if it's really too hard to read, it's too hard to interpret, too hard to manage, then why am I trading it? So Elizabeth, to answer your questions, yes, it's the same thing. All we're looking for is a trend. Options or stocks. If I'm buying calls or buying puts, I'm just looking for the price to move in a particular direction. That's how I make money. I make money based upon whether the stock goes the direction that I want and the distance that I need. So, only way to profit, only way to make money is if I correctly interpret the direction of the stock and the distance it could go. If I can't do either of those things, I'm not going to make money buying calls or puts, nor will I make money buying or shorting stocks. So I have to be able to do both. It's much easier if we adopt the thinking that the stock is what does all the work. The stock does the work for us. All we're doing is picking which stocks we want to build our account and how long we want to employ them. So if you have a company, you look at employees and you say, I want to hire this person because they would be a good asset to the company. They're going to build value above their cost. And the more value they build above their cost, the more valuable they are to the company. If I'm choosing stocks to build my portfolio, to build my stock account, to build my profits, the only way to do it is to pick the stock that's actually doing what I need it to do, which is move in a particular direction for an extended period of time. As long as a stock does that, you will make money. If it can't do that, you most likely won't. So this is low-hanging fruit, as the saying goes. Low-hanging fruit, the stuff that is easiest to exploit because it makes itself easy to exploit. The rest of it is a challenge. So if any of you have ever read or seen Moby Dick, the movie, you can chase after the white whale and get yourself killed, or you could just go ahead and hunt the whales that are not giving you a hard time. Your choice. So this would be the easy hunting, and this would be chasing after Moby Dick and hoping maybe I win because I have this vendetta that I've got to beat this stock. I got to beat this symbol. Okay, Captain Ahab went down with the ship. You'll go down with the ship as well if you try it that way. I guess I didn't hear you say Powell was the win percentage for the day, lost over 50% of my day's profit. Yes, you got to pay attention. every day, forexfactory.com tells us everything that's coming up. So whether or not I even mention it, which I always do anyway, but even if I didn't, the information is still there and we know it's important. Okay? All right, guys, I got to run. Have a good afternoon. I'll upload this shortly and I'll see you guys tomorrow morning. Okay? Take care.